Hey everyone, welcome to Freedom Jump. Today, we're diving into one of the most popular strategies for building wealth, dividend investing. Imagine getting paid just for owning a stock. Sounds pretty sweet, right? But is it really all it's cracked up to be? In this video, I'm going to break down the pros and yes, a few cons of dividend investing. It'll show you why the magic of compound interest makes this strategy a game changer for long-term growth. Spoiler alert, I'm a big fan, and by the end I hope you are too. So grab some snacks, relax, hit the like button, and let's get started. First things first, what even is dividend investing? It's pretty simple. When you buy shares of a company that pay a dividend, they send you a chunk of their profits usually every quarter, like a thank you check for being a shareholder. Some companies like Coca-Cola or Johnson & Johnson have been paying and even increasing their dividends for decades. That's where the real magic happens, especially with dividend growth stocks. Okay. Let's kick things off with the pros because there's a lot of them. Passive income you can count on. Dividend investing is like planting a money tree. Once you own the stock, you don't have to do much, just sit back and collect those payments. Whether it's £50 a month or £500, it's money coming in without you lifting a finger. Dividend-paying companies are often big established names. These stocks tend to be less volatile than, say, a new tech startup. When the market's freaking out, your dividend checks keep rolling and giving you peace of mind. Here's where it gets exciting. Some companies don't just pay dividends, they raise them over time. These are called dividend growth stocks. If a company increases its dividend by 5% or 10% a year, your income grows faster than inflation. Now let's zoom in on the real MVP, compound interest. When you reinvest your dividends, meaning you use them to buy more shares, you kickstart the snowball effect. Those new shares will pay dividends too, which buys even more shares and so on. Over time, this turns small investments into serious wealth. Okay, I promised I'd cover the cons too. So let's be fair, dividend investing isn't perfect. Compared to high-flying growth stocks like Palantir, dividend stocks might not double your money overnight. They are more about steady gains than explosive growth. So if you are chasing short-term wins, this might not be your vibe. Companies can cut or stop dividends if times get really tough. Think of the 2008 financial crisis. It's rare for the big players, but it can happen, so always pick solid companies and do your research. Taxes can take a bite in most places. Dividends are taxed as income, which can eat into your returns if you're not in a tax advantage account like a Roth IRA. Let's circle back to compound interest because it's the secret sauce of dividend investing. With dividend growth stocks, you're not just banking on the stock price going up, you're building an income stream that grows on its own. Picture this, a company like Procter & Gamble has raised its dividends for over 60 years. If you invested £5,000 in P&G 30 years ago and reinvested every dividend payment, you'd have a small fortune today, not just from the stock price, but from a dividend payout that's way higher than when you started. So there you have it, the pros and cons of dividend investing. With passive income, stability, and the wonderful power of compound interest, it's one of the smartest ways to build wealth over time. I'm sold, are you? If you like this deep dive, smash that like button, subscribe, and ring the bell. Drop a comment below. Do you currently invest in dividends, or are you more of a growth stock fan? I'd love to hear your thoughts. Until next time, keep growing your wealth, and I'll see you in the next video.